Hello, this is Jim Smith at GannAnalysis.net. Today we're talking about the 10-year note futures, and this is yesterday's close. It's actually, bonds are trading up a little bit today, but effectively this chart is calling attention to the fact that you have a 45-month cycle at work. If we start from this high to this low, it's 45 months, and you can see it catching turns pretty much every 45 months. Most recently, this summer, it looks like another top. If you start taking out, say, 135.23, you'll probably have confirmation that this indeed was a top. So that was a former top from June of 2012, and you take it out, you're in real trouble. Remember, with Gann, it's always time and price. The cycle gives you a likely turn in time, but you don't confirm it until you take out a key support level. In this case, I think it'll be 135.23 on the September contract. So we are looking at the 10-year note futures September, and this changes every, it'll shift to the December contract fairly soon. But the reality is that for the time being, you want to look at this level, 135 and 23/30 seconds. So what does this have to do with anything? Why should you care? Well, if you give your money to some fund manager, and a lot of them invest 40% in bonds, 60% in stocks, depending on your age, they might do 70/30 or 50/50, whatever. They're going to have some mix that they prescribe based on your age. And I'm just saying it's nonsense. It's total nonsense, because the reality is there are times when you don't want to be in bonds, and there are times when you don't want to be in stocks. But nobody ever tells you, hey, there might be a time when you don't want to be in stocks or bonds. We know we have a passive investing bubble because the amount of capital invested in stocks on a passive basis is approaching 50%. And a lot of people have warned, you go past 50%, you're in a crisis. Things will get out of control. People call it the tail wagging the dog, where too much money is invested passively. There's not enough differentiation. If this fund manager says, oh, this is a great stock, well, why does that matter anymore? Because everything's passive, so you're forced to buy everything in the index. If you're targeting the S&P, everything is weighted according to what's in the S&P. And you're going to go, oh, why do I need a fund manager? I'll just invest passively. Is that a good idea? I don't think it is. But it's also true that bonds are dangerous, because the Fed just came out and said they're going to do something called average inflation targeting. So what does that mean? If they're targeting 2%, if it runs hot, inflation's running hot at, say, 2.5%, maybe the Fed doesn't do anything because they're looking at an average over time, and they might have the view that, hey, maybe it'll drop back to 1.5%, especially if stocks start to sell off and the economy goes into recession. So the problem with that whole concept is that it's sort of like moving the goalposts. First you say 2%, and then you say average 2%. So what you're really saying is you'll live with 2.5%, and before you know it, the Fed will say, oh, we'll live with 3%. We'll target an average of 3%. It looks like it ran a little hotter than we expected. Inflation is now 3.5%. Oh, well, we'll average it at 3%. You can see where this goes. It's a slippery slope. And that's, I believe, what this chart is telling you. If you look back, starting in September of 1986, that was eons ago, but every 45 months you either get a high or a low, and that's a Gann cycle on a long-term basis. It's something to pay attention to. And most recently, June of 2020. So the idea is, if you start to see it sell off here and it takes out this former high of June 2012, then you have a time and price setup. What it really means is, right now, somebody can argue with me and say, oh, I don't believe it'll work this time. Who knows? They might be right. But I'm saying, if you if you actually monitor this and you see bonds selling off and suddenly it's below 120, or excuse me, 135 and 23/30 seconds, well, on the spot futures right now we're targeting September, but if it takes this out, guess what? It probably goes down to this trend line. If it takes that out at 123.25, well, then you're really in a serious amount of hurt because you're breaking the long-term uptrend. Now, why should we say that this is definitely going to happen? Well, the reality is we don't know. Nobody knows. So if the Fed wants to come out and say, oh, we didn't know we were going to cause a depression, maybe somebody will believe them. But from a Gann perspective, I'm saying the 45-month cycle is pretty reliable. If you want to argue with me and say it's not going to work this time, you have a fair point. The Gann cycles are not perfect. They don't work every time. All I'm saying is that on a risk-adjusted basis, or if you want statistically over time, if this thing has worked since 1986, calling highs and lows every 45 months, do you really want to bet it's not going to work this time? You might be right. It might not work. It might be that bonds will rally from here, but if they do start to plunge, that begs the question, what's going to happen next? Now, some Fed watchers, some people might say, well, the Fed's really just trying to move money out of the bond market into the stock market, and this is actually a good thing because it'll force bondholders to sell their bonds and reinvest in the stock markets. Because, why? Because there's no alternative to stocks. They've forced you out of the bond market. It's a command economy. You can't go with cash because cash is trash. So you have to go into the stock market. Well, what's wrong with this scenario? What happens if cash is not trash? What if people say, hey, I don't like the fact that tech stocks are so toppy. I think there's a lot of risk there. Maybe I just want to sit out for a while and get no return on my money. Some conservative people might do that. And if enough people do it, that would be a real problem. Or they might turn around and say, hey, commodities are starting to move up. Look at lumber prices. Look at gold and silver and copper. Look at even soybeans and corn. Things are starting to move. Maybe I'll buy into commodities. And, your fund manager, a lot of people will tell you, oh, commodities are risky. What they don't tell you is, hey, what's more risky right now, tech stocks or commodities? Tech stocks are through the moon. Commodities are beaten down. You tell me where the risk is. I think the risk is that people might say, hey, the Fed has given us the green light to buy commodities because they're saying they're targeting this notion of the average target for inflation of 2%, when in fact what it really means is they'll live with 2.5%, maybe 3%. So at that point, it's a green light for higher inflation, and maybe that's what the Fed wants. But I'm just saying they might get more than what they bargained for. Inflation might run a lot hotter than they expect. And if that's the case, people are going to look for assets that go up with rising inflation. What might that be? Oh, bingo. Commodities. Guess what? It's a commodity bull market. Do you really want to be invested in tech stocks, the FANG stocks, at current levels? If there's some sort of rotation out of tech into some other sector, wow, that could be a crisis. You can wait for the bubble to pop, and nobody can pick the exact day of the top, or you can, take your chances and live with the risk, or you can get out and go to cash. Whoever lost money by going to cash? Granted, you don't make money, but who lost money by going to cash? I don't know. I just think the risk right now points in one direction. Bonds are risky, stocks are risky, especially tech stocks. So I just think you need to clearly reassess your portfolio and think about what's really going on out there. And if some cookie cutter fund manager tells you, oh, you got to follow this pattern, your financial advisor says, oh, you got to put 60% in stocks, 40% in bonds, just tell them to take a hike. That's crazy talk. I just think you need to think logically about where the risk is right now. The risk is clearly in the stock market. It's clearly in the bond market. There is no rule that stocks and bonds both can't sell off at the same time. I think it will happen. So I'm just telling you, think hard about where you put your money. And if you're confused, you're not sure what to do, it's not the worst decision in the world to go out there and put a little bit more money in cash. If you don't know what to do, I think you should park more money in cash. I just think, that makes perfect sense to me. And if you want to take a little more risk, maybe you put a little money to work in commodities. But I sure as heck would not be buying tech stocks up at the current levels. And I sure as heck would not be buying bonds at current levels, especially as this 45-month cycle comes due. So just food for thought, something to think about over the weekend. And you might want to think about what you want to do next, especially knowing that this bubble rally in stocks is not going to last forever. So think about it, decide what you want to do. But this is, to my thinking, a very risky time for both stocks and bonds.